Mr. S. Krishnakumar, CIO of Equity at Sundaram Mutual Fund, is joining us right now. Mr. Krishnakumar, thanks very much for taking out the time. Let's talk about how you have gauged all the recent data points that have come out, be it with regards to growth, be it with regards to foreign investors who are missing right now, obviously this being a holiday season, market that remained sideways to negative the last few days, so saw a little bit of a give back. But does it look more positive as we're stepping into 2020?
Yeah. Good morning. I think you summed it up, right? 2019 has been a year of a downward slope in terms of growth, in terms of data that we have seen on core indicators, high frequency indicators, etc. For the last couple of months, however, we are seeing that the growth slowed down and looks like bottoming out in the third quarter of December. So we do see that the factory orders are getting a lot better. The stocks on the in the markets, the inventory destocking has happened in the festive season. So we are seeing more output on the car side from the factories. Better production numbers are anticipated in the next couple of months too. So this, coupled with the fact that the consumer durable sales have been rather steady at around double-digit growth, we do believe that the economy will pick up steam in the next 1 or 2 quarters. The government also has started accelerating spend post July, August. Last 3 months they have been spending more than 10 to 12 lakh crores per month, and this number is quite aggressive compared to what they did in the first 4 months of this year. So I think a lot of the tightness that arose from the government expenditure being slow is going to give way, and you will see a lot more circulation of money from that side and execution of projects. The second thing is in terms of the NBFC sector, which remains a strong bloodline, along with the banks in the Indian economy. You've seen repeated interventions from the government and the RBI to get the liquidity going, make the banks lend to the NBFCs, take some securitization deals, etc. Even yesterday we saw a little bit more, changes in the relaxation in certain conditions which are non-operative. So with some of these measures and downward sloping interest rates that we are seeing, we do see that liquidity is going to get a lot better. More NBFCs will get funds at a lower cost, basically. The corporate bond market is also getting a little softer as we speak, and in spite of RBI being on hold, the bond yields could, for the corporates, the spreads could come off. So all these point to a easing scenario for the corporates at large, and we see that liquidity coming back to normalcy in the fourth quarter, and recovery is very imminent. So looking forward into 2020, we see the year exiting at above 6% growth by the third to fourth quarter of CY20. So equity investors could remain quite optimistic about the next 12-24 months of growth revival. And equity investing is all about investing, and the chips are down, and there's blood on the street, and there's a lot of uncertainty and doubt. I think that's when investing makes a lot of sense and makes a lot of returns for the investors at large.
Krishna, good morning. Neeraj here. Wondering, there are a lot of people who say that the markets may be pricing in 2 quarters out, but if you look at the mid cap and the small cap space, that space isn't quite showing that there is going to be a recovery. So to my mind, would you be more bullish on that end of the spectrum now because valuations are in your favor, or would you rather bet on the tried and tested? The allocation, where will you allocate more?
Well, Neeraj, as I always mentioned, a disciplined investing, for a retail investor is all about getting the mix right, depending upon his risk profile, basically, right? So I think a balanced approach of spreading our investments across the large cap funds and mid and small cap funds would be making a good sense. So I don't want to advise and bet at trying to just look at mid cap and small caps and neglect the large caps. even in the large caps, the story has been very polarized, as you would see. Data suggests that it's been a handful of stocks which have held up the Nifty over the last 2-3 years, and the rally is just getting broader in the last 1 or 2 months. So we do see a lot of good benefits that would accrue by investing across the large cap space. So the advice is to be investing into a lot more diversified equity funds, basically, which would spread across the sectoral landscape and be able to pick good stocks in different sectors. And of course, as the liquidity improvement in the economy flows through, and various sectors that one would track would see better numbers in terms of high frequency indicators, that would be available over the next 3 months. That's when I think, you would see a lot of money getting into the mid and small caps also, as then there's a confirmation of a broader recovery. So I think we need to, synchronize our investing style along with a broader recovery that we expect in the next couple of quarters.
Krishna, just one question. Firstly, with regards to whether or not we should pay heed to the fact that we've got a pause in the rate cycle. Enough liquidity has been spoken about, but the transmission of that hasn't happened. You've got the government taking proactive measures. But do you see any of that showing meaningful results and therefore reflecting on the stock prices of specifically NBFCs, housing finance companies, some of these PSU banks? What's your take?
Yeah. Definitely, I think over the last 2 months, we have seen that a lot of NBFCs, which are not the top 5 corporate-backed names, other than them, a lot of others, which are probably tier 1, lower tier 1 and tier 2, have been getting funding, both from the corporate market, from the bond market, and from the retail market. So, and if you look at the bond yields for those papers, they've been coming down by about 20-30 basis points over the last 2 months. So that clearly signifies what we've been talking about. Further to what happened yesterday, I think we expect a lot more liquidity to flow into the NBFCs from the banks through various securitization deals, with the government pitching in with the first loss subsidies guarantee. So we do expect further thawing of interest rates for NBFCs, more liquidity available over the next 1 or 2 months. Of course, these are measured steps taken by the government yesterday based on feedback on why the original scheme was not operative, basically. So they have removed a lot of the thorns on the way, and so things are going to get a lot more smoother to operate in the next 1 month. So we do believe that the beaten down NBFCs and the HFCs would see some relief in the next 1 or 2 quarters. Of course, all this would vary based on each company's balance sheet and exposure that it has. But overall, sectorally, there is going to be a little bit of a positive uptick for them.
Krishna, final question. What within the broader end of the spectrum are you not touching with a barge pole as well? Anything that you're negative on?
We continue to remain, pretty soft on the metal space. We do believe that, with the kind of uncertainties that remain globally, and with China probably hitting a 6% and below kind of growth, given the oversupply that exists across broader economies, we think, there could be more uncertainties or, less of strength in the metal space over the next 1 year. However, we would like to keep a watch on what happens on trade war front, etc. And globally, if things do pick up because of the US-China trade wars getting settled, then of course there could be a tactical trade there. But from a structural basis, we still are quite negative on the metal space at this point in time. The second space that we have been generally avoiding is the PSU bank space. That's again because of the broader range of uncertainties that they're facing. It is not only the exposures that these banks have in terms of the mid-market SMEs, where there's been some stress emerging, plus also the fact, more importantly, that these banks are going through a phase of consolidation. Many of them are getting merged, And in this phase, we would believe that the managements of the banks would be more engaged in consolidating and taking more operative and organizational decisions, and be focused there rather than be able to grow the balance sheet and aggressively lend, which is a need of the hour. So we would wait for further signals to find how the banks are coping up with the consolidation and also looking at growth going forward. So these are the two areas where we would wait and watch.